Good morning and welcome to the First Property Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO Ben Habib. Good morning to you.
Good morning. Thank you very much, everyone, for dialing in to listen to the results today. Before I start, I just want to say, some of you may not be familiar with what I'm about to say, but I just want to say that sadly, a month ago, a gentleman called John Kotler passed away. John had been a leading light in my life and introduced me to property and was one of the founding shareholders in First Property Group, and a very supportive, wise gentleman on whom I could always count for good counsel outside of formal structures. But sadly, he passed away on the 19th of May, and some of you you may remember him, and so I just wanted to pass that on. Right, turning to the results. This has been, if we go, you should have a presentation in front of you, and if we start on page 6 of the presentation, which sets out the principal highlights from the last year. We earned a profit before tax of 3 million versus a loss of 4 million in the prior year. That is substantially as a result of what would appear to be the end of the reduction in property values that we have been experiencing over the last 3 to 4 years, basically ever since lockdown started, and then we had the inflationary spike and interest rates going up, all of which has been terribly bad for property and about which I've spoken in the past. So we've had, I think, probably the worst of what has been before us has now gone, give or take a regional war in the Middle East, which may or may not emerge in the next few days. But it would appear that we're at the bottom of the cycle in terms of value reductions. And it was the absence of impairments that allowed underlying profitability to come through. We also made some trading profits during the year through FBROP Phoenix, in which the group has a 23% stake. And the aggregate net result of all of that was to turn the loss round from 4 million to 3 million profit, which is, frankly, a relief, I'm sure, for all of us. And I hope this now presages the re-establishment of the growth trajectory, which had typically been the case for First Property Group until lockdowns commenced. We're not looking to the future through rose-tinted glasses. A lot of the headwinds that have been created by government policy and markets over the last few years will continue. But I think this is the beginning of what should be a better period in the future. And I'll come back to that, about what the headwinds are and where our opportunities are going forward. During the course of the year, we also reduced our costs, which we announced earlier, and that has come through in these figures as well. We reduced gross debt by £3.25 million to £24.37 million, and we reduced net debt by £3.4 million to £19.55 million. So on an LTV basis, actually the group is in very good shape. Our loan to assets, the ratio has dropped quite dramatically over the last few years. And so the balance sheet is steadily getting stronger. But the point of caution that I would make there is that notwithstanding the reduction in debt, because of some of the regulatory changes that have taken place, banks are very reluctant now to lend on property in the way that they used to be, certainly for the bulk of my career. And so debt is not proving to be a friend of property. And frankly, the sooner we can get rid of our debt, the better. It's not serving to boost returns, cash returns, in the way that we would have hoped. And if you've got questions on that, I'd be glad to take them. Our cash position is robust. As some of you will recall, we did a small fundraising last year, which was necessary for reasons we set out in that fundraising, and that has kept our cash position, cash position reasonably secure. There are other pockets of cash which the group would otherwise be able to tap into, but isn't tapping into through its associates' investments, isn't tapping into it because of the caution with which we need to treat debt. So some of our associates in which we have investments are sitting on cash, and we're not releasing the cash from those associates back to the shareholders in those companies, including ourselves, because we're holding the cash there to make sure that we can deal with any debt issues should they arise. And this is a reflection of one of the consequences and a reflection of the tighter debt markets that we face. And as a result of the enormous headwinds that we've experienced over the last 4 or 5 years, we have been selling down property. There's also been a reluctance of investors, more generally pension funds and institutional investors, to invest in property. So our AUM has been reducing. And what you will see, what we experienced last year, and I think what you will see going forward, and has traditionally been one of our strengths, is that we will now act much more as a principal when it comes to property than as a fund manager, because and this is not the first time we've had to do this in a property cycle. The last time we did this was 2009, 2010, when institutional investors withdrew from the market. Being proprietarial in our nature, we were able to deploy our own capital and take advantage of opportunities as they arose. And I think we're back at that kind of point in the cycle. So you will probably be seeing, you'll see less AUM in the group, but you'll see more proprietarial type deals where we will be using our own capital. Capital is tight, but we will find ways to maximize the use of our capital to do deals ourselves and make what we hope will be, significant profits through those deals as we go forward. So AUM becoming less of an important figure for the group, and our ability to find investments from which we can make money becoming a more important characteristic. Of course, that may be slightly discomforting for shareholders, because when you're in the business of buying and selling property in that way, you're not even as good as the last deal you did. You're only as good as the next deal you might do. And no one knows what the next deal is that you might do. But we've been here before. We're an experienced management team. I spent most of my life before First Property Group and significant periods in First Property Group having to, as it were, live deal to deal. And I think the environment will suit us, and we will make good money going forward. But of course, you just have to believe that at this stage. Turning over to page 7, it's a slight pictorial representation of what I've just been through. Big turnaround in our profits from a loss of 4 million to a profit of 3 million. Earnings per share similarly up 140%, not quite as big as the profit increase because of the dilution as a result of the share issue that we did last year. And FX not playing a massive role in in the underlying composition of our profits. Basically, we had the same FX rate with the euro, which is the principal currency against which our profits may move. The euro sterling rate hasn't moved materially during the period, so hasn't had a bearing on either the value of our properties or underlying profits. On page 8, we set out how NAV has moved, and you can see that NAV across the board is up, which is all good news. The share price this morning popped up a little bit, but that does mean that there's an even greater discount now between our share price and the net asset value of the group, which I hope will encourage all of you to look with interest at buying our shares. Not that I would advocate anyone should do such a thing, but it may encourage you to do so. Cash balances, as I mentioned, are up. Cash per share not up as much. Cash per share going down as a result of the share issue that we did last year, but actually total cash going up. Page 9 sets out the debt picture that I described, to the gearing ratio at book value. Remember, we hold our properties at the lower of market value. Typically, we hold our properties at the lower of market value, or what we bought them for. And gearing ratio book value, so that using that metric, is 35% at 31st March 2025, down from 41% the year before that. And gearing ratio at market value, even lower at 31%. So from an LTV perspective, the group is in a very good position. Turning over to page 10, you see how NAV has moved over the last few years. Book NAV is the orange bar, EPRA NAV, which is essentially holding properties at market value and tax affecting them for any gain that would imply. For the first time in a long time, going up. I think the last time we went up was September 2022, which was a marginal increase on March 2022, and then it's basically been in decline. But now we're back up, a reasonable percentage. Page 11 gives you what's called a NAV bridge, explaining how NAV has moved from last year to this year. I won't go through that, and I'll let you review it, but by all means do ask questions at the end if you'd like to. Dividend, we did discuss dividend yesterday, but I don't think we are in, when I say yesterday at the board meeting to approve these results, we did discuss it at some length, and we resolved that we're not at a position to declare a dividend yet. Things are looking rosy, but we do need to hold cash for investment purposes, because that's going to be increasingly important in our ability to generate profits, but also to make sure that even though our gearing ratio is low, that we go forward with absolute confidence and resilience in any debt refinancings that we have to conduct. So dividend, sadly, still zero, but the position of the group improving. And it was encouraging for me, frankly, to be having a discussion about dividend yesterday. We haven't even had a discussion on it for a while. Turning over to page 13, basically what I've already said, we appear to be at the bottom of the cycle. Now, this may be a good time just to remind shareholders why property has been in such a bad place. And really, even though income was impacted by lockdowns themselves, we were able to navigate. I think in the end, we collected something like 98% of the income that we were due during the lockdown period. But what ensued after lockdown has been much more damaging to property. First of all, we had the interest rate increase, which, as everyone will know, has an immediate adverse impact on property values and the returns you can make from a leveraged portfolio. So we had a reduction in capital values that took place after we unlocked the economy. That was made worse by the regulatory regime that governments across Europe and the United Kingdom have been implementing. And there are essentially two aspects to that regulatory regime. The first is regulations which incentivize institutional investors not to invest in the real economy, but to buy government bonds instead. Governments are very, very hungry for money. And so all the capital adequacy requirements that have been foisted on institutions basically directs them to buy government bonds rather than invest in shares or property. That's the first thing. And so we've seen an exodus of buyers of commercial property from the market. And then the other thing has been the requirements for properties to reach ever greater net zero standards. And in the UK's context, that means reaching an EPC C rating, an energy performance certificate rating of C, by 2027. And an energy performance certificate rating of B by 2030. And the impact of that has been twofold. One, a lot of properties have simply become redundant. And those properties that are capable of being improved to the requisite energy performance certificate ratings have required a lot of capital expenditure to be spent on them. And both impacts are obviously damaging to the value of property. So we've had an exodus of money from property, from institutions and banks. And so classic credit crunch, at the same time as the government has been requiring us to spend ever more money on upgrading our properties to meet with their net zero targets. This has been very, very damaging. And to give you some understanding of how damaging it's been, we're looking at buying a property. I won't tell you where, but we're looking at buying an office block in the United Kingdom at the moment for £5 million. And it last traded in 2022 at £18.6 million. And so that's in 3 years. There was it's worth less than a third of what it was, 3 years ago. A remarkable collapse in values, and I don't see that that position reversing itself in a hurry. But what it has done is create the opportunities for us now to look at buying properties where we might be able to do something clever and reposition them. And it's for that reason that I say we are treading cautiously, but our fortunes have improved, and I hope we can do some good deals to continue to drive the growth in the company. And that's about it. Page 12 sets out some of the overarching reasons you may wish to consider buying shares in First Property Group, including, of course, the substantial discount to NAV at which our shares trade. And I think having done that, let's go to questions, if that's a good thing to do at this stage. So I have a question from Nigel C. What are the prospects of leasing the rest of the Warsaw office block? Well, they're good, Nigel. We've leased up a lot of the Blue Tower office space. In fact, we've only got 2,300 square meters left in Blue Tower, which is the building to which I think you're referring. And we've even leased up space that we didn't think was capable of being leased because it didn't have adequate natural light and so on. So I'm very encouraged by the real economy in Poland. Tenants and occupational demand continues, give or take whether or not there's a big overhang of office space in a particular location. Central Warsaw is good. There's been an absence of new developments, and so a property as well located as Blue Tower, commanding the kinds of rents that we're commanding there, has been of interest to small and medium-sized businesses and government agencies. So I think Blue Tower is fine. And as I say, the real economy in Poland across the board is doing quite well. Krakow, though, for example, isn't doing well, and that's not because the economy of Krakow is not doing well. It's because there's a significant overhang, and there are pockets of overhang, particularly when it comes to offices in Poland, about which we need to be cautious, and of course we're aware of, and so are cautious. But to answer your question, the prospects of leasing up Blue Tower are good, and one of the reasons we need to keep our cash resources intact and able to be deployed is so that we can, fit out the properties fit out Blue Tower as and when that last 2,300 meters gets leased. Question from Sam E. What specific catalysts such as revaluations, leasing success, or fund disposals do you believe could materially drive the share price in the next year? The thing that would most materially drive the share price up, well, I can't talk about the share price. What would drive our net asset value up and be a dramatic change for the better for the group is a release of the capital constraints on the market. And so if we saw interest rates in the West, I'm just talking about Poland now for a second. If we saw interest rates in the West reduce, it doesn't look like they're going to reduce anytime soon in any material way. But if we saw interest rates in the West reduce, what we would then see is capital going back to Central and Eastern Europe, which is effectively the carry trade from which Central and Eastern Europe benefited from for so many years. But the other consequence of interest rates going up when we unlocked the economies was that capital was sucked out of Central and Eastern Europe back to the West. And the markets in Central and Eastern Europe turn, dramatically on Western capital. And so we've got this classic credit crunch going on in Poland, and we need interest rates in the West to reduce before we see, I think, capital going into Central and Eastern Europe, propping up their banks and propping up their institutional and other demand for property, propping up international demand for property in Poland. That would be a significant game changer for us. The rest of it, I think, is just working to maintain income levels, increase income levels, pay down our debt, and then get more free cash being released back to the group. Sam E asks, what would need to happen to bring the dividend back into play? Well, we need to go through, there are a couple of refi events coming up in the next year or two. We need to go through those, see what the real economy, how the real economy, particularly in Poland, is performing, whether or not we're able to obviously refi these positions, what our debt, what level of cash we would need to deploy to the debt in order to sustain our position. Once we've gone through that, then I think we can look more positively at the dividend. But as I say, for the first time in a number of years, we did have a good discussion about dividend yesterday, which in itself I think is encouraging. How are we doing with occupancy rates, and can we fill all our existing voids soon? There are some buildings which have what I would call structural vacancies. So, we have a little shopping center in Krasnystav where there's always some vacancy. We have an office block in Lublin where there's always some vacancy. We have an office block in Poznan where there's always been some vacancy, but we do release it. The important property that we need to lease is Blue Tower in Warsaw, which I've already addressed. And if we can lease that, then I think things are looking pretty set fair. Another question from Nigel B. Is there an issue with this being vacant for a long time? I guess you're referring to Blue Tower, and no, there isn't an issue. The 2,300 square meters. Remember, we bought this space in August 2022, when things were quite different to where they are now, and there isn't an issue with it having been vacant. We will, I'm reasonably confident, lease it up quite soon. And I don't think there are any other questions.
That's great. That's great, Ben. Laura, thank you for addressing those questions for investors today. I believe you have addressed all those questions. And Ben, before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Ben, could I just ask you for a few closing comments?
Yeah, so as I say, I'm delighted by the turnaround in our profits. I'm delighted by the strength in our balance sheet. I'm encouraged by the kinds of deals that we're now seeing. I think shareholders need to be aware that creating a company with the levels of AUM that we had in 2018 is going to be well, it's not on the cards for the next few years. The fortunes of the group turn on the kinds of deals that we can do, whether we can buy stuff well and make money out of it going forward. And we've been here in the past. Some of the best deals we did were deals we did in 2009, 2010, and in the years following that. And let's just see how things go. We've navigated this difficult period to the best of our ability. It hasn't been good for shareholders, but I hope that negative period is now behind us.
Fantastic. Ben, Laura, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of First Property Group PLC, we would like to thank you for attending today's presentation, and good morning to you all.